What if you could invest like one of the richest entrepreneurs in the world without all the complexity? You don't need to be a tech genius to make your money work for you. With the right mindset and a few simple principles, you can start mastering investing like Mark Zuckerberg. Now you might be thinking, but Mark Zuckerberg, isn't he a billionaire because of his tech empire? What does that have to do with me, an aspiring investor? Let me stop you right there. The truth is, Zuckerberg didn't get where he is by relying on complex algorithms or being the smartest in the room. He built his wealth by mastering a key principle. Investing is not about being the smartest, it's about making smart, strategic decisions. And here's the kicker: you don't need to overcomplicate things to succeed. While you might feel overwhelmed by the countless investment strategies out there, the fear of missing out on the next big stock, or the temptation to chase risky trends, here's what Zuckerberg's success can teach you. It's all about simplicity. Stick to what works. Now let me ask you this: do you really understand the balance between risk and reward? Because in the world of investing, emotions like fear and greed can cloud your judgment and push you to make decisions that you'll regret later. Today, I'll walk you through the very principles that have helped Zuckerberg and countless successful investors build massive wealth over time. Principles that are simple, actionable, and most importantly, principles you can start applying today. Let's begin with the first key lesson: simplicity in investing. It's time to cut through the noise, focus on what matters, and avoid the temptation to make things harder than they need to be. What if I told you that investing isn't about being the smartest person in the room? What if I told you that the world's most successful entrepreneurs didn't get there by being tech geniuses, but by following a few simple principles and mastering their emotions? Take Mark Zuckerberg, for example. You probably know him as the mastermind behind Facebook, now Meta. Zuckerberg didn't build one of the world's most valuable companies by overcomplicating things. He didn't have some secret algorithm or some genius-level formula that no one else knew about. Instead, he kept it simple. He invested in what he knew, what he understood, and what worked. And that's the key to successful investing, no matter how much money you're starting with. Here's the truth: investing is not rocket science, and it's certainly not tech genius-level science either. Zuckerberg didn't start Facebook by predicting the future or creating some complex technology that no one else could understand. He simply created a platform that connected people. The idea was simple, and he executed it well. The same applies to investing. You don't need to know every financial term or follow the latest market trends. What you need is clarity on what you understand. Successful investors focus on what makes sense to them, whether that's technology, healthcare, or any other field they know well. For example, if you're passionate about healthcare or technology, start there. Invest in industries you understand and are interested in. Don't get caught up in trying to predict every market fluctuation. Keep it simple. Stick to what works. Here's the harsh truth: one of the hardest parts of investing is not picking stocks or reading financial reports. Controlling your emotions, particularly fear and greed. If you've ever experienced market volatility, you know exactly what I'm talking about. One day the market is up and the next it crashes. It's like a roller coaster that tests even the most experienced investors. But here's the secret: the investors who succeed are the ones who remain calm through the ups and downs. Think about Zuckerberg again. When Facebook went public, its stock dropped. Many people panicked and made hasty decisions. But Zuckerberg didn't. He stuck to his vision, stayed focused on the long-term goal, and didn't let fear or greed push him into bad decisions. As an investor, you need to do the same. When the market goes down, it's tempting to panic, sell everything, and cut your losses. But that's often the worst thing you can do. On the other hand, when the market is soaring and everyone's talking about the next big thing, it's easy to dive in with everything you've got. That's when greed takes over, and it's easy to make rash decisions that will hurt you later. Here's the bottom line: it's not about being the smartest person in the room. It's about staying calm, staying disciplined, and sticking to what you know. The market is full of noise, fear, and greed are everywhere, but the best investors are the ones who block out the noise. They stay true to their principles and stick to their strategies. This principle of simplicity and emotional control applies not only to Zuckerberg or high-profile investors. It applies to you. You don't need to be a genius. You just need the discipline to stay focused, stick to your strategy, and remain calm no matter what the market throws at you. That said, investing is more than just staying calm and sticking to what you know. It also requires a long-term mindset. In the next section, we'll talk about why patience is one of your best assets, and why the best investors don't rush. They take their time to let their investments grow. But before we move on, remember, simplicity and emotional control are the foundations of successful investing. Just like Zuckerberg kept it simple and stayed calm in the face of adversity, you can too. What if you stopped focusing on the next big win? What if your primary goal wasn't instant success but lasting growth? The greatest investors, Mark Zuckerberg included, don't think short-term, they invest for the future. Zuckerberg's vision for Facebook wasn't about immediate returns. He wasn't chasing a quick exit strategy. Instead, he was building something that would last. He looked at the long-term picture even when the odds were stacked against him. Analogy: think of investing like planting a tree. When you plant a seed, you don't expect it to shoot up overnight. You wait for it to grow, nourish it, and give it time. Over time, the roots grow deeper, the trunk stronger, and the tree bears fruit. That's the essence of long-term investing: patience. The growth isn't immediate, but the rewards are worth it. Statistic insight: Mark Zuckerberg's multi-billion-dollar empire didn't happen in a day. He stayed focused on the long-term goal, and that's the mindset every investor needs to adopt. The perils of short-term thinking. In the world of investing, it's easy to get caught up in the idea of quick profits. Many investors chase the next big thing, stocks that are soaring or hype-driven trends. But this short-term thinking often leads to disaster. When you're fixated on the short term, you can make rash decisions based on emotions, fear, greed, or impatience. Just look at the market downturns that have shaken many investors: 2008, 2020, and other crashes. People who sold in panic, driven by fear, often locked in their losses. Those who stayed calm, who didn't react emotionally, were the ones who rode out the storm and came out stronger. Remember, it's not the short-term gains that matter. It's how you position yourself for the long term. Consider Mark Zuckerberg's approach with Facebook. He didn't launch the company with a goal of an immediate IPO or instant financial success. Instead, he envisioned a platform that could change the way the world connects. He weathered challenges, setbacks, and competition, but he remained focused on the bigger picture. While others may have sold out during tough times, Zuckerberg doubled down on his vision, and that dedication paid off. He didn't sacrifice his long-term goals for short-term wins. Take a moment to think back to the 2008 financial crisis. Investors who were driven by fear, who sold at the bottom, lost out. Those who trusted in long-term strategies, who stayed calm during the storm, were the ones who gained the most as the market rebounded. This is a perfect example of why long-term thinking wins. No matter how much the market swings or how chaotic things may seem, the investors who remain focused on their goals and not on immediate returns are the ones who emerge victorious. It's not about the next big win. It's about building for the future. The key takeaway here: long-term thinking outlasts short-term gains. Don't be distracted by fleeting opportunities. Focus on the bigger picture. Long-term thinking outlasts short-term gains. Investing is like planting a tree. If you nurture it, water it, and give it time, it will grow into something solid. But if you uproot it every time it faces resistance, you'll never see it reach its full potential. Now, I want you to reflect on your investment goals. Are you thinking in terms of years or just days? When you plan for the future, your success isn't about how much you make next week or next month. It's about where you'll be in 5, 10, or 20 years. So ask yourself, are you investing for tomorrow or just chasing short-term wins? So we've established the importance of long-term thinking. But how can we protect our investments as we move forward? Let's dive into risk avoidance and how you can minimize exposure to major pitfalls while maximizing your growth potential. Investing isn't about avoiding risk, it's about managing it wisely. It's easy to assume that the smartest investors never take risks, but that's not true. The key isn't about avoiding risk, it's about managing and balancing it. This is what separates successful investors from the ones who make costly mistakes. Mark Zuckerberg's success didn't come from taking extreme risks, but from calculated risks, the ones that made sense for his long-term vision. Let's dive into how risk plays a crucial role in investing and how you can manage it to your advantage. Zuckerberg's approach to risk. When Facebook was in its infancy, Mark Zuckerberg took bold steps. He accepted funding that allowed him to scale quickly. He acquired Instagram, WhatsApp, and Oculus, each with potential risks attached. But Zuckerberg didn't gamble everything on these decisions. He approached risk in a calculated way, not as a reckless bet, but as a measured choice to build for the future. Key insight: investors don't need to take extreme risks to win big. The idea is to manage risk, not avoid it entirely. Understand that every investment, even in something like Facebook, comes with risks, but it's about making decisions that are informed and calculated, based on facts and analysis. Zuckerberg understood this, and so should you. Investing in risky, speculative assets or relying on debt to finance investments can lead to disaster. Overleveraging, borrowing money to invest may seem tempting, but it can leave you exposed if markets turn. It's essential to stay away from get-rich-quick schemes that promise fast returns. The truth is, they're often too good to be true. Chasing hype stocks like those in speculative tech or cryptocurrency bubbles can be tempting when you see other people making quick profits. But remember, for every success story, there's a long list of people who lost everything chasing the next big thing. The 2008 financial crisis is a prime example of what happens when risk isn't managed correctly. Now, here's the real secret: self-investment. While it's important to diversify your portfolio, the best investment you can make is in yourself. Your skills, your knowledge, your mindset. This is the foundation that protects you from the volatile ups and downs of the market. Mark Zuckerberg's success didn't just come from his financial decisions. It also came from his ability to learn and adapt. Over the years, Zuckerberg invested in learning about business, technology, and leadership. He took courses, sought mentorship, and read extensively. The better you understand the world around you, the less likely you are to make decisions based on fear or uncertainty. If you've ever felt uncertain about an investment, ask yourself, do you understand what you're investing in? Have you taken the time to learn about it? The more you learn, the more confident you become in making sound decisions. And confidence is key in managing risk. When you know what you're doing, fear and greed lose their grip on you. Zuckerberg didn't stop growing after Facebook became a giant. He continues to expand his knowledge about AI, virtual reality, and other cutting-edge technologies. He understands that if you stop learning, you risk becoming irrelevant. As an investor, this philosophy applies to you too. The best investors constantly seek opportunities to expand their knowledge. They never assume they know everything. Zuckerberg's example teaches us that learning never stops, and the more you learn, the better prepared you are for whatever challenges come your way. You don't need to take extreme risks to succeed. You need to make smart decisions. The best investment you can make is in yourself. Just ask Mark Zuckerberg. This key point cannot be stressed enough. Your wealth doesn't just grow through risky bets. It grows through calculated, informed decisions and by investing in yourself. You can weather the toughest storms and avoid the worst pitfalls by staying educated, staying disciplined, and continuously growing. To wrap this up, let's reflect on the key lessons from today. Risk management: it's not about avoiding risk, but managing it wisely. Understand the risks you're taking and make informed decisions. Avoid unnecessary risks, don't chase speculative opportunities, or take on debt you can't afford to pay back. Stick to what you understand. Self-investment: the best way to protect yourself from financial risks is by continuously learning and growing. The more you invest in yourself, the better equipped you'll be to navigate the complexities of investing. Success in investing doesn't come from taking wild risks. It comes from focusing on what matters, staying disciplined, and investing in yourself. Remember, every investor has a unique journey. Your path to wealth is about making wise decisions and continuously improving your knowledge. Whether you're a seasoned investor or a beginner, your best bet is to take the long-term approach and avoid unnecessary risks. Keep investing in yourself, and over time, the rewards will follow.